so much for solidarity within the EU. You can see that now it looks like the EU was nothing more than a fig leaf for, German political hegemony throughout Europe. So we're right back where we've been since the 1860s. Not a lot's changed. And it's an extremely dangerous situation.
Monday, December 15th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, I have the pleasure of speaking with Peter Carlin again today. He's becoming a regular guest. He's the co-author of A Pocket Book of Gold with Jim Sinclair, the late Jim Sinclair, a survival manual for monetary mayhem. And Peter, I think we are in monetary mayhem right now. So for those of you who weren't able to get a hold of the physical book, there's now not free PDF, but it costs $25 a PDF for the book. I'm going to put it down in the link in the description. Peter, welcome back.
Good to see you, Mario. We're starting the week with a bang.
Yeah, I saw that Friday we had a little bit of a pullback. Gold and silver were trading quite strongly, and then they came back down. Silver finished down. Gold still finished up. But I noticed, Peter, longer term, we had the highest weekly closing price for gold and silver. And and it still feels like a lot of people are bearish. So I think that in of itself is a positive. You said to me before we started that you wanted to look at Europe because you think it could be a momentous week shaping up.
Yeah,
and it's
definitely.
all to do with the Russian assets. So maybe we could start with that.
Yep. Yeah. I mean, here we are, this is Monday morning at 8 a.m. out of London time. And we're already up 2% in silver and 1% in gold. And I think the real tenor, the real flavor of the market this week is all centered around the codification of this permanent freeze of Russian assets held in Euroclear. So this is pretty much tantamount to a confiscation. Although I can't understand for the life of me how something that's permanently frozen can be collateralized against, because when you need to call on the collateral, then it's not going to really function. But it's just another name for taking the assets, for stealing the assets, if you like. And I think, quite honestly, it's about as close as you can get to a declaration of war without actually declaring war. It's an extremely serious step, which is why everybody, including Euroclear itself, the ECB, the World Bank, the IMF, the US government, the Belgian government, the Hungarian and Slovakian governments, as well as other people in Italy, in Italian politics, are all against it. But the hierarchy of the EU, which is completely now German comprised, of Merz, von der Leyen, and Manfred Weber, head of the EPP, the European People's Party, the largest bloc within the EU, have just taken control of the situation, and they're going rogue. They don't care what anybody else in the EU says. Merz has even said if the EU cannot make progress with negotiating with the United States and discussions about the Ukrainian situation, that we are prepared for Germany to speak directly to America outside of the EU framework. So, I mean, so much for solidarity within the EU. You can see that now it looks like the EU was nothing more than a fig leaf for, German political hegemony throughout Europe. So we're right back where we've been since the 1860s. Not a lot's changed. And it's an extremely dangerous situation. And it's sending shockwaves through the whole world financial system. Now, you have this reassertion of German hegemony, which is now kind of laid bare, laid naked in front of the world. between them and Kaya Kallas, where does the participation come from Spain, from Portugal, from the Eastern Bloc, who've had governments removed and turned over? The entire thing is becoming unstable. Obviously, it looks like you're not going to really have the situation continue forever. Eventually, it looks like the EU is not going to make it. It can't under these conditions. But along the way, a lot of horrific things can happen. I mean, if you take the EU now and you look what it's done in large, it's managed to make an enemy out of Russia completely, almost at war with Russia, a quasi-enemy out of China. You see how the EU delegation was treated the last time they went to Beijing, when they were put on a common bus and rolled in like tourists, which is not really red carpet treatment. And the EU has ticked off the Trump administration because of its intransigence over movement of of Ukraine, and so you've got a perfect trifecta. You've pissed off the Russians, the Chinese, the Americans. All you have to do is do something to tick off the Indians, and you'll have the whole planet against you. So anybody of any economic, political, and military significance are all standing on the opposite side of the EU. So they talk of war. They have no capacity to wage it. It's some kind of collective insanity. I mean, NATO is running on fumes now. Obviously, the Trump administration is trying to get out of NATO, or at least it's making a huge move towards distancing itself, is not even gradually now, at a fairly breakneck pace. And so, militarily, it doesn't make any sense. They're seeking some kind of a confrontation, which will allow them to default on their debt and blame it on Russia. Because look at it from a military standpoint. Europe has no air defense of any significance. If the Russians, who probably have tens of thousands of drones in reserve, launched an all-out drone assault on Northern Europe of like 35, 40,000 drones in a night, or 2 or 3 nights on the running, which they have. They produce about 500 of these a day that they don't use. So, do the math on that. That's a lot that you've built up over the past year or two. This is really turning into a very, very unstable situation. And, all the European politicians, especially Macron, Starmer, they have no public support whatsoever, and yet they go on. And so we're seeing it in the medals. We're seeing it in the medals. It's starting, as I say and have said in the book, and as everyone I'm sure familiar with it knows, gold is a barometer of fear. Gold is a barometer of existential security, and rises when that existential security is brought into question. And that is what we're living through now. So for everybody who was going to cheer when we got to 5,000, you can now see what the price of getting to 5,000 is. Complete economic existential insecurity, which is what everybody's living through. This is not a good situation. NATO has been fairly soundly defeated in Ukraine, even though, if you believe the American press, Russia's about to collapse. I mean, I do not know where people get this from. A cursory look at the military disposition of the Ukrainian front will tell you, the loss of Pokrovsk, the fact that Odessa now is swarming with Russian agents about to take over the city, the attacks on the port, Turkey now castigating this attacks on these tankers. The Turkish military alone could probably take on most of Western Europe. If they ever teamed up with Russia or fought, not even alongside, but on separate theaters, they would be in control of Eastern Europe in half a year. So it's a mess, and the market's reflecting that. So I don't know. Shall we move on to the market itself?
Yeah, just one comment on the the funds, the frozen funds. I read that like two-thirds of that is actually owned by private Russian citizens.
Correct. Even
Yeah,
more.
yeah,
Yeah.
and
Yeah, it is. So it's personal confiscation. It's
yeah,
not You're not really going after Russian government assets. It's
yeah,
like a shakedown,
yeah,
And the thing about it is that the blowback is going to be, well, twofold. The blowback is going to be on corporate entities that still exist in Russia, which are still significant and probably upwards of, I don't know, they're saying 1.2 trillion worth, but those are going to be taken over, liquidated, I don't know what, by the Russians. And then, the whole game plan seen in the bigger context that the victory of Europe within Ukraine would make good on the now 250 to 300 billion advanced, through Ukraine debt mechanisms,
yeah,
for concessionary debt, is going to zero, and it's going to take the EU with it.
yeah. Anyway, let's move on to the markets then.
Okay, so an interesting thing on Friday, and I think if we take a look at the weekly, the diff, the ratio spread, I think we're starting to see a little change of tenor in the market. I'm not sure if it's in full flow yet, but we saw a really strange unwind late on Friday. Now here's the big picture of how the diff has moved, the gold silver ratio spread, and we can see there the peak. I know, some people use spot. This is future on future. So, we get up there towards 105. We don't get a close there. We can see how long the diff has been in that range between the red bands. And now we've come all the way back to the bottom of the range and blown through it. And if we move from the weekly to the daily, you'll see that what we have is the creation of a waterfall, and that little green bar, which was Friday, shows you the trend line is still intact, so the waterfall might not be done. But we saw, if you go to the 30-minute, in the last few minutes of trade, you can see that
Yeah, I haven't got that one.
oh, you didn't get that one. Okay.
No,
It should have been.
I'll bring it up on my. I can
Okay.
do that. Hold on.
You can see that there was a big unwind at the end of the session, where silver turned around and fell like 3.5% while gold was going up. And so I think we've had the diff. We might be bottoming out short term, and while the diff is still coming, going lower today on the opening, I think we're about to see, because of the situation with the Russian assets, we're about to see the central banks come storming back in. Yeah, there's the big move up. You can see that two legs. What do we got there? An hourly or 30-minute?
This is an hourly.
Yeah. So you can see right there that the traders unwound their position in the second half of the trading day. That tells us quite a bit, because it tells us that you can see what the professionals are up to. They've been financing the silver longs through shorting gold on a money basis, 1-for-1. So they've been juicing the silver market relative to gold, because they're not just punting silver long short. The professional world is trading it. It has to sell something to get the length on silver. And so they've been selling gold, and they've been using the diff. So that's been the trade of the past 6 months. And, what a trade it's been. We have seriously moved. So, since June, it's been one-way traffic. And now, we have some indications that, we're starting to unwind. The Friday was a clear out. People have been selling gold to pick up the alpha and silver, and now it looks like that might be rebalancing. I'm looking for the diff to start going back up, maybe not this week, next week, but starting to go back up. And with the global tensions, I think you're going to see the central banks are going to start piling in again. Everybody's getting very unnerved by the situation with Ukraine and the Russian assets. And that's going to bring big players back in. And when they come in, they're going after gold. They're not going to,
Yeah.
if they lay into silver, we'll be at $200 in a
Yeah.
week, and then nobody will be able to deal with it. So, there's no depth in this. There's not enough depth in the silver market to take. So the ratio has completely come in, and the weekly chart showed you just how strongly it has come in. We've had a waterfall over the past few weeks where it got really, really out of line. And now I think, we might be reaching the end of the waterfall and getting ready for a gold resurgence relative to that. Now, I want to stress that, none of this means that flat price silver is going lower. It simply means that the balance between the two might be changing and that the ratio may be prepared to come back up for a bit. So, it's not Carlin saying, sell all your silver.
Yeah, so you still think silver looks good. But it's just that there's gonna be a rebalancing of that spread, and there's
Right.
some. I saw this tweet this morning, and I'll bring it up for you. It's about SLV, which is a derivative of silver, but nevertheless. And I've interviewed Just Dario. He's a really good macro analyst.
Right.
He's Italian and he's based in Hong Kong. He used to work in banking, but he said, holy crap, the open interest SLV calls January 16th, expiry is 68,000. And you can see here, the strike price is, where is it? 70, which is the equivalent of 80 in normal spot silver.
Right.
So, I mean,
So
68,000 is quite
everybody's
huge. I know you're an options trader and everything, but it doesn't necessarily mean this is going to happen. But the fact that someone willing to bet so much on that is significant as well.
right. Well, there's two sides to the street. You've got retail and the paper who are going to buy those calls, or, I didn't get to see the whole thing. It doesn't matter, but, or people buying call spreads to try and get the upside action. So there could be that. But remember, the market makers are going to need gamma on the upside because that's what allows them to sell closer to the money. Nobody wants to be short premium in this environment with the market ratcheting around, but there's obviously some interest from paper to take the wings of the market. So you're telling me that this strike is equivalent to a $70 silver
$80.
$80 silver call that expires on Jan 16.
Yeah.
Okay, so you've got a month to run. Yeah, why not? I mean, that's your protection, and then I guess you can try and guess what strike. The pros can try and guess what strike.
Yes, maybe someone has done like a 65-70 call spread, because the open interest in the 65 strike is quite high as well.
Right.
Who knows?
Yeah, it's all on the upside. It's how the retail, trades the market as opposed to the pros. The pros are just the professionals the market makers are vol traders. They're trading volatility.
Yeah.
And so that means that, they're going to take gamma on the upside and try and allow them to stay short some of the premium closer to the money. Although it's a bit of a chasing game. Volatility in silver must be screaming now. So it's a tough game. It's a tough game to play. I think 80 might be a stretch, but if we make it through 68, 69, you'll get 80 in the bag within 2 to 3 months. I think one thing that the paper is telling me too is that, and I would have to agree with retail in that sense, which I rarely do, is that the beginning of next year is just terrifying to the market. We might get through Christmas.
What do you mean? What do you mean by terrifying?
I think we're going to see, the way the EU and the ECB reacts and everything. Everybody starts at the beginning of the year with some fantastic new plan, and so we might have a lull through Christmas and the New Year. Bureaucrats like to take time off too, and then they'll come storming out at the beginning of January and say, central bank digital currency, all exports of gold, forbidden, this, that. Who
Yeah,
knows? Who
yeah.
knows? But that's where it is. Now the proximate cause of the collapse of the diff on Friday, or the reason why the diff has been collapsing, because everyone's looking for it. I think it's tough to attribute anything to a single cause, but you have had Russia in the market selling gold, and they obviously have a fair amount of gold. They evidently have about 2,400 tons. I think it's probably a lot more, but they have a war to finance, and this is one of the ways to finance it. As the saying goes, if you don't sell into a rally, when are you going to sell? But that's only like 3 to 5 tons. It wasn't really some kind of huge movement, but they need liquidity to go and to keep the currency going too, which quite honestly is the best performing currency of the past year, 30% up in a year. So while the yen is reversing out, and the ruble, albeit from quite a low level, has taken back a lot of the losses that that it's faced in the past 3 to 4 years. So the Russians were the gold seller. Everyone else is either holding or accumulating. So there's still not a lot of sellers in the market, except the miners, and the miners are kind of like the retail gold dealers, silver dealers in the West. They're kind of reticent to let go of too much inventory too. I mean, once again, going back to retail, if anybody's checked in with the London market for silver rounds, it's insanity.
Yeah, I was just checking.
40% over spot.
I know I was just checking one of the biggest dealers online. They're paying like £50 for Britannia 1 ounce silver,
Is that
and
what
the
they're selling it?
spot price is 47. They're paying above the spot.
Oh yeah,
Yeah,
absolutely. And
for you to sell to them.
the offer?
Sorry?
Where's the offer?
Oh yeah, it's probably more like £70. It's
Yeah,
ridiculous.
exactly.
Yes.
Which is what? Which is $90.
Mm,
The
yeah,
market in the low 60s. Their markup is now 50%.
yeah,
50% plus if you don't take serious size. So, the mining industry is probably very happy to let things sit too. But the central bankers now are in full mode of purchasing again, and it kind of makes you wonder. The central bankers are chasing the market higher as it goes higher. Where were they 15 years ago? Why are they forced to chase now? This is central planning for you.
yeah.
They
Well,
sell
I,
the low, they buy the highs.
the thing is, the Western central bankers aren't even buying. At least these central banks have been buying, like the Global South or BRIC central bankers. They've been buying massively since 2022. So they've actually done pretty well.
Pretty
It's
well.
us here in the West that, are stuck. UK is stuck with only 310 tons,
That's as
which
much
is,
as Portugal has more.
yeah, I think they're, as a percentage of their foreign reserves, it's almost like 80%. And talking about central banks and gold, you wanted to touch upon gold and sovereignty and Italy and what's going on there. That's an interesting topic.
Yeah, we're really seeing a move back towards people fighting for monetary sovereignty. You know, and This is where you're going to see you know that the producers are going to start to gain a real edge. Now, I sent you a chart of the producers from the World Gold Council, and I'd like to speak up for old WGC. Everybody likes to bash them, but the truth of the matter is that they're the best information source we have these days. Everything else is just rumor. They do the hard work. This is annual production in terms of tonnage. And, with the price movements now, I think 1 ton of gold is worth 125 million. So you can see that China and Russia are up at the top, with Australia just slightly behind, and the U.S. kind of tapering off. But, currency is predicated on foreign exchange and global gold reserves that central banks hold. So, what member nations have, what nations hold in reserve is the way they support currency, or at least relaunch currencies if the old ones die out. So, you still have a situation where, nobody believes the Chinese number of 2,400. I myself don't believe the Russian number of 2,400. That would, or thereabouts 2,200. That would cluster more or less Germany, Italy, China, and Russia all in the same area. But as you can see, with domestic production, which in China and Russia is going to be completely shut in, and Indonesia now, which is more or less putting a very tight lid on sales, that the producers have the ability to underwrite currencies better than countries who are simply have to go into the open market. Italy doesn't really produce gold, neither does France, neither does the UK. So we're going to get to a point, I think, where people are going to start to look at a nation's gold reserves and their ability to produce together, and it may determine the future of their currency. Japan also has no production to speak of. They have a lot of refining, but not a lot of production. So,
nor Germany.
Nor Germany. And the bigger problem is that with Germany, they've got about 35% of their gold is still in the Federal Reserve basement. With Italy, it's about 40%. And moving it is neither easy or is it politically easy either. So just so everybody knows, possession being 9/10 of the law, you've got 40% of Italy and Germany, the top two European nations, that their gold is not really held completely within the country. Some of it's still in London, but like I said, 1/3 to 40% of it's still held in New York. The only difference with that is France, who has all their gold, in France. If you look at the logistics of what it took to get it back from New York in the 60s, it was quite a lot. It was, 38 different ships over a period of 5 to 7 years. Finally, they gave up and they started taking the risk of putting it on airplanes to fly it in. But, a lot of these issues are coming up now because you can see the scramble starting to develop. We just had this hiatus with Italy, where the Italian government came out, Meloni government came out and said gold should be the property of the people. And the ECB chimed in and said, well, of course, dear, of course it's the property of the people. It's just us who controls it, that's all. So you can see that the scramble for control of the gold is going on. So they want it to be the people's gold. The government says it does, when really they want to get their hands on it. There's an ECB statute, which is common in other countries as well, too. Bit more pronounced within the EU, that gold reserves cannot be used to finance social spending. So, the gold doesn't get liquidated to pay pensions or to pay unemployment, or so the law states. But if you're under the EU directive, then I suppose as long as you're a member, you're going to have to show some fealty to Brussels. So my question would be, if Italy is now talking about putting 12.5% tax on private holdings of gold. And private holdings of gold in Italy are massive, 5 to 6,000 tons, twice what the central bank holds. If the gold is the people's gold, why are you taxing them on their private holdings? So we'll see what happens with that, whether that's going to be possible. And also, quite like the idea that capital gains should be paid on unrealized gains, it's inventory that they seem to want to tax, not tax when you sell, tax mark to market at $4,300 an ounce.
Yeah.
Well, if gold goes back to $3,300 an ounce, do they give you 25% back? No, of course not. So, this is a very dangerous game they're playing. And you can see it's getting to be a disorganized scramble now to get your hands on money for these governments. Italy, debt to GDP ratio is 135%, second only to Greece. Depositors have moved tons of money out of Italian banks. In fact, deposits of Italian residents within Italian banks at their lowest level since 2017. Where are they going? I don't know, probably Switzerland. That's the closest thing. Anybody who knows Switzerland knows that if you sit around Montreux long enough, the bus loads of people from Italy come every single day. I don't believe they're just coming to look at the lake. There's plenty of nice lakes around Cuomo and places like that.
Yeah, that's right.
Once upon a time, they used to have a submarine, a small submarine that used to go into Italy across the lake, transporting people's gold.
Yeah. Well, there's also like a Swiss city called Campione d'Italia that's within Italy, so which is quite interesting by the lake. So you can go there too and not get out of Italy. Go in,
Right.
it's weird.
Right.
But it seems to me that we're right in the eye of the storm, the monetary chaos and mayhem. And what Greenspan also said years ago that, during times of war or extremis, he used that term. There's only one thing that works in terms of payment, and that's gold. Paper is no good. And I think that's why, like you said, you expect central banks to come back into the gold market, and you call it the diff. I never heard that. That's the gold silver ratio. That's the professionals call that. So the diff is going to rebalance a little bit. But the other thing about the diff or the spread is that in major precious metals bull markets, that spread generally goes lower. Do you think that trend is still there despite the fact we might see a correction?
Yeah, but I think it'll be more towards when things get more chaotic and you start to see, to me and you, it's amazing how retail in the West still doesn't participate in this game. When that starts to happen, then you'll see the diff start to go down. I don't know. I don't believe that we're ever going back to 16, like people say. But I think, I certainly think 50 to 40 is on the cards. So yeah, I mean, it's a big move. There's still a way to go. And again, both are rising in tandem. It's just how they balance as they rise.
Yeah.
And at the tail end, and Jim, my erstwhile co-author of the book, said that you will get, when the bull is in full flow, you'll get gold, you'll get silver screaming. And quite honestly, I think now, you're really starting to see a situation too, where the Indians are starting to show interest in retail silver as well too. Gold is getting expensive for a lot of people. So silver is a natural place to go. I still look at these things like electrification, which are things that I was not very interested in before. But when you start to research them, you see that there's going to be some kind of demand for it. And it could be a fairly fundamental shift in the market too. But Do I think the diff can make it back to 50 or 40? Yes, I do. I do. But I still think that that might be a year or two out. The point of the matter, and Jim and I used to discuss this all the time, is Jim used to say something, because he doesn't really talk for the sake of talking when he means it. He said, this time around, and I've always been against this thesis, but now I see what he was talking about all those years ago. Because this time around, we may never sell. And to me, as a trader, that's just like, oh, come on. You're going to wind up like people in the 1980s and 90s, where you held for 2 decades and watching it. But with the crack up that's going on in the West, I'm starting to believe that he and Harry had a real insight into this, and he might be right. And in that case, the stackers are going to be the ones who run away with it. They are. I mean, I myself believe in the segregated position, the stack and the trading book, completely divided, completely segregated. But you can see where. I don't know what I have a hard time seeing, maybe not for the United States, but for Western Europe, surely. I don't see how they get out of this mess now. Unlike the United States, they're not sitting on a quadrillion cubic feet of natural gas and, a couple 100 billion, barrels of crude oil like you have in the Permian Basin, like you have in Texas, Oklahoma. There's all sorts of factor endowments that Europe is short in, and it's becoming difficult to see how that is going to play out in the European zone. They look incredibly vulnerable now, incredibly vulnerable, and China and Russia's trend is just in motion and carrying on. They are starting. It's they, like Jim Rogers and other people always say, the 19th century was the century of Britain, the 20th century was the century of America, maybe the 21st century is the century of China, and it certainly seems to be a trend in motion. So we'll see, but we'll see. But I think the market now, we've seen it bolt out of the gate this morning. The Asians continue to buy, to accumulate. The accumulation in Asia now is getting pretty strong. I mean, thank God, the Australians have a good solid mining industry, because it could be the thing that saves them.
Yeah. Well, Peter, it was great speaking with you again, and I think the 21st century will definitely not be the European century, and. Yeah, with that, I say hold on to your gold, be your own central bank, just like Peter and Jim advised in this book. Thank you, Peter.
Good. Speak soon.
Yeah.
Have a good week.